Welcome back to the Deep Dive. Today we're jumping right into Domino's Pizza, ticker DPZ. We're looking at their Q3 2025 earnings and, really importantly, their outlook for the rest of the year.
Exactly. The mission is pretty straightforward. Break down the key numbers, figure out what actually worked for them in Q3, and pay close attention to what management is saying about, well, the broader economy tightening up.
Okay, let's hit those headline results first, because they did beat expectations. Diluted EPS came in at $4.08. That's better than the $3.96 consensus analysts were looking for.
Right, though slightly down from $4.19 last year. And revenues were solid too, $1.147 billion, which is a 6.2% jump year over year.
And operationally, things look strong. Income from operations climbed 12.2% to $223.2 million.
Yeah, that's a really healthy number. Even if you take out a small, like $0.8 million currency benefit, it's still up 11.8%. That points to some real efficiency in the core business.
It does. But then you look at the bottom line, net income, and it actually decreased 5.2%. It fell to $139.3 million from about $147 million. That's the kind of thing that can make people pause, right?
Absolutely, if you don't dig a little deeper. But the sources are clear here. That drop was mostly, almost entirely, due to a $29.2 million swing in pre-tax unrealized losses. It's tied to an investment they have.
An investment in DPC-Ltd, which, for you listening, is one of their big international master franchise partners.
Exactly. So it's not really about the day-to-day pizza making and selling. If you kind of mentally set aside that investment volatility, the fact that the actual operating income jumped over 12%, that's the real signal. The pizza engine is humming.
Okay, got it. Core operations are healthy. So what about looking ahead? Management seems pretty confident sticking to their full year 2025 guidance.
They are. They reaffirmed the big one. U.S. same-store sales growth, SSS, still expected at 3%.
And internationally.
They're guiding to a 1% to 2% range for international SSS.
Yeah.
Seems like they expect to be at the higher end, unless things get rocky globally. And overall operating income growth, they're projecting around 8% for the year. Again, taking out currency and one-off items.
Plus, they're still building. That U.S. net store growth target is still 175 or more new stores. That tells you they believe the franchise model is still working, even with costs going up.
Which really leads us to the core question of the quarter. How do they manage that strong Q3? Can they keep it going to hit that 3% U.S. target?
Right. So global retail sales were up 6.3%, excluding currency, but the U.S. SSS, that was the standout, right? Accelerated to 5.2%. That's a big leap from 3.0% the year before.
A huge leap. And the CEO, Russell Weiner, he pointed directly to their hungry for more strategy finally clicking. The key was driving positive order counts.
So what specifically did that? The sources mentioned two main things.
Yeah, two big ones.
Yeah.
The really aggressive best deal ever promotion and the new Parmesan Stuffed Crust pizza. Seems like that combo really resonated.
Okay, and that 5.2% SSS, how did that break down between, say, delivery and carryout? Because that tells a story, too.
Oh, it absolutely does. The split is pretty stark. Carry-out comparable sales.
Yeah.
Up a massive 8.7%.
Wow, 8.7%.
Yeah. Driven by, the new menu items, the loyalty program kicking in, and especially that best deal ever, which really pushes people towards pickup.
Okay, and delivery, their traditional strength.
Delivery grew too, but more modestly, up 2.5%. It got a boost from the same promotions, but also importantly from the full rollout of the DoorDash partnership.
So if we put that together, the 5.2% overall gain was really driven by more orders, more transactions.
Exactly. It was a volume win. Now, the average ticket did technically go up a bit because of some pricing, about 1.3%, and the higher price of the stuffed crust. But that effect was dampened because so much of the growth came from carryout, which generally has a lower ticket price.
Yeah.
So volume drove the growth big time.
Which raises the question, was this profitable growth? Or were they just buying market share with those aggressive deals?
That's the million-dollar question, isn't it? Management argues it's strategic, setting them up for the long run. And that brings us neatly to the DoorDash effect, the aggregator partnership.
Right. Q3 was the first full quarter with DoorDash fully rolled out across the U.S.
And management is really bullish on this. They expect it to be a meaningful driver and, importantly, a compounding driver for U.S. sales growth, not just in Q4, but well into 2026.
Is it profitable for the franchisees, though? That's always the concern with third-party apps.
They specifically addressed that. Management stated these orders are priced with franchisee profitability in mind.
Yeah.
The CEO made a point like Domino's already delivers, what, 1 out of every 3 pizzas in the U.S. overall?
Yeah, something like that.
But they see huge runway on the third-party apps themselves. They want to grab more share from that other two-thirds of the market currently ordering pizza through aggregators.
Makes sense. So beyond DoorDash, what else is working strategically? You mentioned innovation.
Right, the Parmesan Stuffed Crust was clearly a hit, generated buzz, higher ticket,
Huh.
but they also did something smart operationally, introduced simpler bread bites.
And that replaced the more complex bread twists.
Exactly. So it's innovation that potentially drives demand and makes life easier in the kitchen. Faster prep, better throughput, especially important if you're pushing carryout.
And underpinning all this is a brand refresh, the first in over a decade.
Yeah, first in 13 years. It's fully paid for by the franchisees through their national ad fund contribution, that 6% fee. And the goal seems to be shifting perception, not just value, but also emphasizing deliciousness, quality, being the quality value choice.
Okay, so they're pulling multiple levers.
Yeah.
Deals, innovation, aggregators, branding. But there was a warning, right?
Right.
About the economy.
Yes, and this is crucial context. Despite their Q3 success, management, specifically the CFO Sandeep Reddy, cautioned that they are, and I'm quoting here, definitely been seeing a slowing across restaurant industry sales as Q4 started.
Oof. So the party might be slowing down for everyone else.
It seems that way. It suggests that while Domino's might have successfully stolen share in Q3, the whole pie might be shrinking now, or at least not growing as fast. The CFO even added that if the macro picture gets even further intensified, it could put pressure on hitting that full-year 3% U.S. SSS target.
So they're fighting on two fronts, executing their strategy while navigating potentially tougher consumer spending.
Precisely. It's a real balancing act, especially when your strategy leans heavily on value and driving transactions.
All right, let's shift quickly to the operational structure, store growth.
Still positive. Globally, they added 214 net new stores in Q3. International was the main driver, with 185 net new units, particularly strong growth in places like India and China.
But wasn't there an issue earlier with an international franchise closing stores?
Yeah, good point. That 185 number is after accounting for the fact that DPE, a big franchisee, closed about 200 stores back in Q1. Management believes those closures are now largely behind the business, so future growth numbers should look cleaner.
Okay. And margins, any pressure there?
It's a mixed bag. The supply chain side is doing great. Their gross margin there actually increased by 0.7 percentage points, mainly thanks to being smart about procurement, getting better deals on ingredients and supplies.
That's good news.
It is. But on the flip side, at the U.S. company-owned store level, gross margin actually shrank by 0.5 percentage point.
Why was that?
Two main culprits. Higher food costs being passed to the stores from the supply chain, despite those procurement wins, and just higher wages. Labor costs remain a persistent headwind.
Got it. Okay, let's wrap with capital allocation. How's the cash flow looking?
Very strong. Free cash flow jumped significantly to nearly $496 million, up from about $376 million last year. That reflects the strong operating performance and maybe some tighter capital spending.
And they did some debt refinancing.
They did. $1 billion worth. They issued two $500 million sets of notes at a blended rate of about 5.1%. They used that cash plus some of their own to pay down some older debt.
Paying off older, presumably lower rate debt with new 5.1% debt? That seems counterintuitive, maybe.
It does on the surface. Management said the impact on 2025 interest expense would be immaterial. But you're right to question it. It likely suggests they're playing the long game, maybe locking in rates now because they expect them to go higher, or just ensuring they have maximum flexibility and a stable structure heading into potentially uncertain times. It's risk management.
Okay, managing risk and shareholder returns. Still happening.
Oh, yeah. They bought back $75 million worth of stock in Q3, about 166,000 shares. And they still have over $500 million, $540 million left on their buyback authorization. Plus, they declared the regular quarterly dividend, $1.74 per seater share.
Okay, so let's synthesize this. Q3 looked really solid operationally, driven by specific tactics like the big deal, the stuffed crust, and finally getting DoorDash fully online. They drove transactions, took share.
Right. They executed well. But they did it against an economic backdrop that management themselves admits started to weaken as the quarter ended and Q4 began.
And management's argument is that these drivers, loyalty, menu items like stuffed crust, the aggregator platform, these are permanent fixtures, not just temporary boosts like some LTOs. It's a long-term play.
Exactly. Which brings us to the final thought for you, the listener, to chew on. If these drivers truly are permanent and compounding, can Domino's maintain that critical 3% U.S. SSS growth into 2026 and beyond? Especially if this tightening macro environment doesn't just stay tight, but actually worsens into a real consumer downturn. How does their aggressive value strategy hold up then, profitability-wise?
It's that tension. Can strategic execution keep outpacing potential economic headwinds? Definitely something to watch.